Note after note in the inbox this morning calls for caution. Strategists sounding the alarm after stocks surged to start the year. Morgan Stanley's Mike Wilson expecting the rally to reverse course, writing the following: while it may take a bit longer for the market to price out materially below consensus view on earnings, we remain convicted in our thesis. JP Morgan's Mislav Matejka echoing that view, recommending investors use strength to reduce exposure, and Goldman's David Kostin warning that the recent gains might be as good as it gets. TPW's Jay Pelosky joins us now to discuss. Jay, wonderful to catch up with you, sir. Let's talk about those views we just got from JP Morgan, Morgan Stanley and Goldman and apply them to the US market before you and I talk China, EM and Europe. Are you on the same side as them when it comes to US equities?
Well, I mean, John, I think we have to acknowledge that several of those guys are stale bears, right? They've been bearish for a long time. They've missed this entire move. And so, you know, naturally, they're not going to capitulate now. I mean, I think our view for the S&P this year has always been kind of a flattish year, right? Plus or minus 5 or 10%, limited upside on earnings, starting point valuation quite high. You know, rates unlikely to go lower. We've never been believers in the recession, as you know very well. We've been a soft landing believers. And so no surprise that when you get a jobs number like on Friday, immediately you have to price out the recession, which, let's remember, 5 weeks ago was the most anticipated recession ever. We wrote about that last week in narrative speed. So you've got to flip that script. No more recession. Rates back up at the long end. Dollar strengthens a little bit. And it's a perfect reason to take some profits on what, as you point out, has been, you know, like a serious rock and roll start to the year.
Well, Jay, let's talk about that rock and roll start. You were also looking for a major move away from big cap tech, and the Nasdaq just posted a 15% return year to date. What's in that? What's behind it?
Yeah, well, rates coming down sharply, right, which was what was pricing in the recession. So we had a huge rally in bonds, which we were not believers in, did not really participate in. I mean, you're not going to get it all right, John, right? I mean, there's going to be a few things even guys like me miss. That's part of the game. So we didn't buy that recession impact on the long end, which supported the tech stocks. And now that stuff's being a little bit unwound. We think that tech is going to continue to be an anchor and a cap on the upside of the U.S. equity market. It's still 20+% of the S&P, and rates are not going lower, in our opinion, because we're not going to have a recession, and therefore that caps the upside of big tech, and big tech caps the upside of the U.S. equity market on a relative basis.